You're listening to Start, Scale, Exit, Repeat, Serial Entrepreneur Secrets Revealed. My co-host has just joined me here on stage, Michelle Van Tilburg. And today we're talking about your startup and funding your startup. And particularly, should you consider venture capital? So we're going to try to tackle that issue, the issue of venture capital. And, it is it a panacea? Is it something that means that once you get it, you are successful? We're going to unpack that, and we're going to talk a lot about that today. I don't think it's going to be totally one way, this conversation. I think, if you read the book, Start, Scale, Exit, Repeat, you know that I have a lot of thoughts on venture capital. It is not as everybody makes it out to be, but we're going to be talking with Ira Weiss, who runs Hyde Park Ventures Partners. He's a venture capitalist, and he's going to give us an update on the state of the market. What's it like out there to raise money for a startup in today's environment? If you're listening to this on podcasts, we appreciate it. We also appreciate a review if you do decide to do a review, if you like the show. Also, we do this show live every Friday, 2 o'clock Eastern on Startup Club, on Clubhouse. And we encourage people to come here and join us on stage. So this is not a typical podcast. This is more like a live radio show, sort of like a startup radio show. And what we do is we bring in people from the audience to ask questions and share information and share expertise. And quite frankly, it's a community. And it's a community that comes together and produces this great content. And we do this every week, every Friday, 2 o'clock Eastern. We have a sister show that we do on Thursdays at 5 o'clock Eastern, which is called The Complete Entrepreneur. And if you're listening to this podcast, you'll know what I'm talking about. And that show focuses more on the human side of entrepreneurship. This show focuses more on the cracking the code. What is it? What is the code? What is it that these serial entrepreneurs do over and over again to start, scale, exit, repeat? And that's the code we've been trying to crack. The book was a 10-year mission. And now we're almost 3 years in on this show. I think we're episode number 177. So we're really getting there. We're really trying to figure that out. And today, hopefully, we can uncover the issue as well related to that. Mimi, I know you're probably working on getting our guest into the room. It can be a little bit tricky on Clubhouse. If you're a guest speaker and you come on and you've never been on Clubhouse, you're not used to it. Michelle, I know you've been an entrepreneur for many years, and raising money has been a challenge years ago and even today. Now it's a lot more challenging in a lot of ways because of the market and the high interest rate environment. What are your thoughts on today's topic? Funding your startup, the right funding for the right situation.
Yeah, I mean, this is like I almost said the $1 million question, Michael, but I'm going to say it's the $1 billion question in today's environment. And I think people really jump too fast to raise too much money, Colin, because if you don't have a proven out concept, if you're not making money yet, if you don't have a network, if you don't have a team in place yet to execute, that can be a massive mistake. As you know, recently we were talking to some folks about doing, a public offering for one of the companies that we manage. And we really had to step back and say, it's not the right time. Because I'm going to tell you this, jumping into venture capital or going public too fast, you can bring yourself down so fast, not yourself personally necessarily, but the whole company. You need to have a lot in place and know that you can quickly execute and grow the company, meaning be profitable and scale. It's good when you can be profitable and scale, Colin.
Yeah, I agree. And we talk about in the book, Start, Scale, Exit, Repeat, we talk about on chapter 28, the title is The Right Funding for the Right Situation at the Right Time. And everyone goes through this process of well, how am I going to scale it? How am I going to raise money? What am I going to do to get to the next stage or the next period where I can take it to the next level? And what we want to do is we want to really think about what is the right type of funding for your company. And in the early stages of a startup, we want to be thinking about angel investment. We want to be thinking about SBAs, that's the Small Business Administration loans, which, by the way, are very expensive now. We were running loans at 3% for paw.com, and now it's 9, 10%. we're looking at a renegotiation of the loan at around 11%, which is still, they still are offering better terms because we can pay it out over 10 years instead of 5 years on the prior loan. But the prior loan went from 3% to 9%. So we're seeing it's a higher interest rate environment, and everything's affected. Everything's connected. When the interest rates go up, when the companies actually stop going IPO, when you see the IPOs drop, you see a down channel effect on the entire industry, on every single startup. It usually has a bit of a delayed effect, but it does come in. You actually are impacted by it. So we talk about different types of funding. I know we're waiting for Ira Weiss to join us here, but I will tell you the best form of funding, I think, is in the United States is under Regulation D, private placement memorandum, where you can raise whatever money you need and you can solicit to sophisticated investors. And I like that group of sophisticated investors because they can actually be a bit of your network. I used to like to say that, when we did .club, we raised $7 million in 30 days. And what I like to say was that it was 29 shareholders, but they were not just shareholders, they were also volunteers. They're the people who help you get new leads. They're the people who help you with your strategy. They help you gain customers. Don't think of a shareholder base as being a liability. They can actually be a very big support network for your business as well. And then also, I do recommend when you do start a business and you're considering funding is to get an advisory board, not a board of directors. This is a little bit different. An advisory board is a group of individuals who come together and help support your business. And they'll do it without the legal ramifications associated with that. Sometimes you'll kick them back 0.25% or whatever. I've been on a number of advisory boards. I've been on a number of board of directors, but sometimes they'll kick you back a little bit of an advisory fee as well. But it's usually a percentage of the upside. It's not like an actual cash payout, because one thing we all know about startups is they don't have a lot of cash. They're broke. Everyone's broke. Every startup's broke, and we need to find ways to raise different money for different situations. So consider Regulation D. Consider sophisticated investors. But I want you to also begin to think about, if you have a group of customers, or if you're aware of Start Engine or our crowd, you should consider doing a Reg CF, and you can raise up to $5 million, and you can solicit securities to individuals, not just sophisticated investors as well. And that's a good opportunity for you to break into a way of funding your company without having to give up control, per se.
You're breaking up, Colin.
Really breaking up. It could be the internet that we have here. Are you?
He wasn't breaking up for me, Michelle.
You're breaking up. We're not.
No, it's you, Michelle. It's you, Michelle.
Can you hear me?
Yeah, we hear you.
Yeah.
All right. So.
Oh, okay.
Oh, where's Ira?
He's still
lost
show,
in.
my friends.
Yeah, we're doing a live show here. Yeah,
She's
and
on
that's
the phone with them.
It's not a typical podcast, right? She's on the phone with him right now, trying to get him on. Again, we know this is tricky stuff. So we talked about Reg D. We talked about Reg CF. This idea you can raise up to $5 million. If you have a larger company, you can consider Reg A or Reg A Plus, where you can raise up to $75 million. And I mean, that might be an option for paw.com, right? At a certain point, is to consider raising money under that premise. We've also considered, even with real estate, doing a token. And if you do a token or tokenize real estate, you still need to do that Reg CF. You can't get away from it. In different countries have different rules. In Canada, they have different rules. But if you're in the United States, you really do have to file with the SEC. And by the way, it's not as scary as it sounds. Like when you do an IPO and do an S1, that is scary. By the way, that is something else. But I'm certain with AI, that's the cost of that is going to come down dramatically. I think we spent, Michelle, $1.8 million on our first, just for the legals and to file the S1 for our first, a company that we did in 2006. So, I mean, it can be very daunting. And that was a successful IPO, and we went public there, which is good. You don't want to go down the path if you don't have something that really will be successful. I'm certain the costs have come down with AI. But for the most part, Reg CF, Reg D, Reg A Plus, they're probably some of the better ways to go. Now, let's talk about these crowdfunding sites like Start Engine or Our Crowd, because what they've done is they've taken these documents, they've sort of like, they're all pretty much standardized. You pretty much have to follow a particular, path of corporate structure, and they'll raise the money for you. But obviously, there's a sexy component to it, right? You can't just come out there and say I'm selling rugs and beds right now. You gotta come out and say I'm selling AI software. And I know we got one of our entrepreneurs on stage here, Michael, who will talk about his company in a few minutes after our guest shows up. But the reality is there are a lot of options, and you have to sort of pick and choose between those options. I often say there are two ways that I think you can fund your startup in the early stages. The first is use the customer's money. We have a chapter in the book on customer funded startup. And let me tell you this, like there probably is no better way to fund your startup than that. I was talking with Michael, who is on stage here, and I was telling him about AppSumo and how you can actually go to AppSumo. You can list your software platform on AppSumo, offer lifetime memberships. Yeah, I know, but you're getting it out there, right? You're getting your platform out there. Let's say it's $99. You raise $100,000 and you do it over a period of 30 days, whatnot, and that helps you get to the next stage for your company. So there are a lot of innovative solutions like AppSumo, Kickstarter, those early stage concepts. But then once you start to take off, once you start to get some traction, then you might want to start thinking about venture capital. All right, I can see we have Ira on stage here. Well, welcome, Ira. I'm sort of like going through the book here on pre venture capital. I'm just going at it and coming up with some different solutions. But Ira, thanks for joining us.
I'm happy to join. So sorry, I was having some technical difficulties. I haven't been on Clubhouse in a bit, but it seems like it was more app related. So that is our tech world these days until AI automatically solves all these problems.
Yeah, exactly. And, Clubhouse has gone through a lot. What we do here is we do a live show and then we syndicate it on podcast. So if you're listening to this on podcasts, the show today is about venture capital and the state of the market and whether you should consider doing that. But first, Ira, I just want to, can you just tell us your story? We always like to hear the stories on this show, right? You can tell us you can do this, you can do that, but we like to hear the stories. So
Sure.
Can you talk to us about how you got started and how you got to the...
I'm happy to do that. And can everyone hear me okay? Because I'm in my ear pods, but if you can't...
No, we hear you pretty good. If you get up the volume just a tiny bit, but that's okay.
Okay, I can do that. So I have a weird path into venture capital, but it's not, there's lots of different paths that people take into venture capital. I would describe my path as like self-taught. I am an accounting professor and I was teaching at Columbia Business School in New York, and I was an academic, but I was teaching there in 1999 when the tech bubble was in its bloom. And that's when I started out there. And another professor and I, Matt Rhodescroft, started writing checks for startups really on the side of being our day job. We kind of like take our paycheck and, find some interesting startup and write a check and go to town. And, I just fell in love with the excitement of the startup world. And so we made a bunch of investments. We formed a little fund that I'll call Pledge Fund, which was called RK Ventures. Made a bunch of investments through that fund. The best known that people may have heard of, which is now going back a while, is a company called the Rackspace, which is still around.
What a great company! We were at not a competing, but similar industry, Hostopia. So Rackspace was a great company.
Yeah, good. Yeah, well, we were at the time we were watching the story of a company called Exodus that was kind of went way up and then went way down. And
that story too.
Rackspace was a little bit more steady, mostly because it had a lot of pornography websites were the big user base. So then I did that for a bunch of years, and then I'm originally from Chicago. I was invited back to the University of Chicago to teach in the business school here. I still teach. I'm a professor in the MBA program teaching venture capital, accounting, tech strategy. And then when I moved back here, there were a couple of companies that actually were started by students at the business school at the University of Chicago. One is called Grubhub, and the other is a company, oh my God, Braintree, that Brian Johnson had started. And so those were two really big successes that came out of really student projects, not student projects, but student founded companies. And the school partnered with some local alumni to start an angel group called Hyde Park Angels. I ran that angel group for a few years and then met a business partner, and we branched off and started a venture fund called Hyde Park Venture Partners. And so Hyde Park Venture Partners, we're a Chicago-based fund. We're investing out of our fourth fund. The fourth fund is a $100 million fund. We primarily do seed up to, I would say, early Series A investing in and around the Midwest plus Atlanta, and we have adopted Toronto as part of the Midwest. So we primarily do kind of the middle of the country. And one of the investments, it's how Colin and I got to know each other. One of our investments that's better known is a company called ShipBob, which is e-commerce fulfillment. We were the earliest investor in a company called G2 that some people use that provides software reviews for business-to-business software. We're early investors in a company called Forkite, a company called Pro. We've got a bunch of different, hopefully interesting companies and so now I split my time. About half of my time is spent with MBA students at the University of Chicago, and about half of my time is with startups and investing in startups.
It's interesting. I know today we're going to talk about venture capital, but what you brought up earlier, this idea of, these companies that start out of the college and the community and an incubator, and I really am a big proponent that a community can really help you launch a startup. And maybe that's my second question right there is like, you don't have to be in the garage anymore. Like the days of Steve Jobs and Wozniak in the garage. Like it's all about connecting into a community and then leveraging that community to help launch a startup.
I mean, I think any way that you can use networks, like whether that's a community network or a school network or your own network, to help, you really need the network to help find, developers, to help find co-founders, to help find early customers, to help find connections to early customers. And so I think you certainly, especially in a world of, the people join accelerators like Y Combinator and Techstars and others. Those are also good paths. But I do think community and networks always helpful.
Absolutely. So let's jump into it a little bit. So, I know you did get a copy of my book, but in the book, I have some pretty controversial statements about venture capitalists. I talk a lot about Silicon Valley disease, what can happen sometimes to these companies that do get too much funding, like WeWork and others. But let me give you a couple stats. Actually, let me ask you, I'm going to put you on the spot, Ira, okay? You ready?
I'm ready.
All right. So what percentage of companies that receive venture capital fail? I mean, this is a point in time where you've made it, right? You've got your venture capital. What percentage fail?
I would guess that's 85 to 90%.
Oh my gosh, I can't believe that. Every time I ask this question, people seem to hit it right on. 75% of companies actually fail. You wouldn't think that if you're really, because generally you've been vetted. Like you're not just a brand new company. You've already had a successful formula. And venture capital comes in post angel, sort of post that, those early investments. You would have thought that there would be a higher success rate, wouldn't you?
Well, I think we'd probably all hope that there's a higher success rate, but and I think our success rate as a firm is quite a bit higher than that. But you asked the generic question, and VCs are willing to take, and I mean, frankly, enormous risks. A lot of the companies we get involved in, they're pre-launch. There's no product. It's just like a couple founders, and so there's a pretty good chance there's just a pretty good chance they're going to fail. And so part of our job, I know, not everyone is thrilled with venture capitalists, but, part of our job is when companies fail is to like help the team find a home for the company or find jobs afterwards and help, kind of pick up the pieces because, in many cases, founders have put their life and soul into a company. So your statistics don't surprise me. I think the better the firm and the more established the firm, the higher the chance of success. And I certainly agree with part of the thesis you laid out, which is, if you take on venture capital money, you do want to be careful about not taking on too much money, right? You want to think about what's the right amount of money for the opportunity that you're working on. And you want to be scrappy. You want to not necessarily bootstrap, but just use the money carefully and not overextend yourself. So, that's a hard thing for anyone to do, because we just don't know, when the company's starting out and in the early stages, how quickly our revenue, how quickly are the customers going to come on board? How quickly our revenue is going to scale?
Exactly.
And so you just don't know.
Yeah, and then in the book, I do talk about how we raised venture capital and how it was very successful, and then we had fun. I had a ghost writer who actually interviewed my former venture capitalist and got his side of the story, and so it was coming together. So I was actually somewhat removed from that aspect of writing the book, but it was interesting because it was strategic. And the right venture capitalist, if there's a particular situation where you need to scale quickly, or there's a venture capitalist that can be strategic in helping you scale, I think those are the reasons you go venture. But I want to get your perspective on this. Like, can you tell us what kind of companies should go for venture and what kind of companies shouldn't go for venture?
Well, I mean, I think there are certainly certain companies that are better suited for venture and others that are not. The way I talk to at least my students about it is, if speed is really important to you, or speed is important to the business model, then, VC money is something that could be attractive. Or, there's some cases where you're not going to have enough money to build what you want to build. So, I mean, look at companies like the Teslas of the world and the SpaceXs of the world. Like, even Elon Musk, at the time that those companies were getting off the ground, like, he didn't have enough money, because there's so much cost and time involved in those kind of companies. So those are companies that may need venture capital. There's a lot of companies out there and a lot of business models where my recommendation is bootstrap as long as you can. But the struggle is, if you're in a market where speed matters, and usually when we think about speed mattering, that is, can you get to a place where you have some kind of a moat, right? And by a moat, usually we think of things like network effects, like the Ubers of the world, right? Where you end up with, you need cars and you need consumers who are going to, take those cars. You need drivers, you need cars. Like, once Uber and Lyft became dominant in an area, then it's hard for anyone else to get launched there. And so anytime speed matters a lot, then I think VC money might make sense. And then another category that you did describe is, in some cases, it can help you find someone who really knows your market and can help you. Like, hopefully you really know your market. But I'll give you an example from my world. One of the companies I'm involved in is called Audit Sites. Audit Site automates financial audits and quality of earnings audits. I am a recovering financial auditor. I was an auditor for a firm called Coopers and Lybrand that then became PwC. I did that for a year. I also teach accounting. I met this founding team, incredible founding team, that were two partners from PwC. They wanted to automate their old profession. And so I am an accounting professor. I'm a former auditor. Like, I'm not sure how helpful I have been, because the founders are pretty spectacular. But I think that was a connection where it's certainly easier for me to understand what they're doing quickly and try to be helpful. And I think we've been a bit helpful in that case.
Yeah, and so we've got a few people in the audience, I know, on the chat, and also if you want to ask a question, just please raise your hand, come join us on stage, ask a question. I know we got Michael, you've lined up to ask a question here as well. And just for full disclosure, this is a company that I've invested in, and I suggested he join us on stage and try to learn from you as to what might be his best options. But we'll jump into those questions in about 10-15 minutes. Before we go there, though, we have a few other questions. One is, let's just say you believe you are a candidate for venture capital. What is the first thing you can do, or the best thing you can do to attract a venture capitalist or approach a venture capitalist? Like, what is the process? So you got a great company. What do I do?
Well, I think my recommendation about how to approach venture capitalists is the same way that I recommend approaching almost anyone in the business world, which is try to get there through a warm introduction, right? And so, what is a warm introduction? And you may not have a warm introduction, but you can create warm introductions. So, not to say that a VC won't consider you, even if it's just random. But like LinkedIn is such a powerful source to look at LinkedIn and see who I know who's connected to the VC. Um, and sometimes the best connection could be through a current portfolio company of the venture capitalist. So you look through their companies, you're like, oh, I have a good connection to this founder here. So generally, I say like get to know founders, especially get to know founders who have venture capital backing, because those are often good warm introductions in. So there are different ways to get introductions into VCs. Sometimes VCs publish the theses that they're investing in, what they're looking for. And so it's also a good way in where you see, look, they've laid out their thesis, they're talking about the kinds of things that they're looking for, and you fit in that bucket. And so then it's still good to get a warm intro, but they're much more likely to take the call, even if you just, ping them on Twitter or ping them on LinkedIn or ping them, just randomly via an email. If you know that they have a thesis in that area. So generally warm intros are good. If you can't find a warm intro, try to get an intro through a portfolio company CEO. And then, if worse comes to worse, you can just certainly randomly ping VCs. I think those are also very good approaches to get to know VCs. VCs do show up to those events. I think like having connections to VCs who show up at those events sometimes is even better than like getting up on the stage and pitching. But I think those are certainly, what I recommend. So maybe let's take a half a step back, Colin, before like, okay, you want to meet a VC. You asked me like, what's the best way to meet a VC? But before that, you want to get a few ducks in a row before you even speak to the VCs, and you want to practice pitching. You want to kind of hone things a bit, practice your elevator pitch, practice your, don't go into the first meeting with a VC raw. And so, usually, people talk about, well, you ask for advice. If you ask for people for money, you'll get advice. If you ask people for advice, you may get money. And so you kind of go around. My recommendation is like go around asking a bunch of startup leaders to give you feedback on what you're doing and to kind of practice honing the pitch and to get a bunch of feedback to get to the point where you are ready to then talk to someone. And even then, there may be a list of like the perfect 30 venture capitalist partners in the world for what you're doing. And you may not want to approach one of those 30 people right away. You may want to practice a bit with some other VCs and then approach some of those folks. And once you get to the point of meeting with VCs and pitching to VCs, the best thing you can do is try to find people who know your market well and can make a decision pretty quickly. The same way that when you look for informal advisors for your firm, like try to find people who know your area or have expertise that is relevant for you and get feedback from them. So it's a little bit of a long-winded example.
No, I like it. And we do recommend a lot of people that they apply for pitch competitions. We have an incubator here in South Florida called the Alan Levan Center, and they put on an incubator. I'm one of the speakers. And there they actually go through a 10-week course, and in the 10th week, they go through a pitching training and all that stuff, and they actually pitch their investment to angel investors in the local community. So, and it's free, by the way. It's free to do these kind of things. So I think you're right. I think it's a great idea to just connect and do those kind of pitch competitions and get involved and learn how to do that. I like the fact that you're also talking about narrowing it down to the right VCs because, here's a small story in my experience. We did an IPO in 2006 and we were a Canadian company. We raised $30 million at the time you could before Sarbanes-Oxley really kicked in. But we raised $30 million and we did 38 interviews. We closed three institutions in Canada and 3 in the United States. But here's the kicker. We did 29 interviews in Canada and 7 in the United States. And yet we closed almost 50% in the United States because we were pitching to the right people in the United States. We were a software platform with accretive revenue. And there are particular VCs that invest in that particular type of company. So if you're pitching to the wrong crowd, you're wasting time. So that's why I think doing your research on the VC and really understanding the kinds of companies they invest in is critical, because you can get a lot of rejection and you might think it's your company or your problem, but it might have nothing to do with you. You're just pitching to the wrong people. What are your thoughts on that one?
I mean, I agree completely. Like finding the right VCs to pitch to. And also, I mean, I've seen this in a lot of our founders, even when they go for follow-on opportunity. It may take a handful of your own pitches and getting feedback to hone the story, because the story, it's not just how crisp the story is, but there are certain things that individuals, VCs like. And, as the story gets honed and you get more and more feedback, the story gets better, and you understand what are the things, what do you need to overcome, just like any other sales process. What objections do typical people have to whatever you're pitching? Is it the market size? Is it the growth? Is it the team? Is it whatever those things may be? The more practice that you have pitching it, the better. So it sounds like your strategy might have been a generic strategy that I would suggest, which is you actually did pitch to a bunch of people in Canada, some of whom were relevant, some who were not as relevant, but that helped you hone the story. Now, maybe, Colin, maybe you're so great that you were able to articulate the perfect story the first time. But
No, I was horrible.
I think that it is hard for anyone to do, because even if you have a good story, it doesn't mean that your same way that you communicate with people, it doesn't mean that the way you tell your story and the things that you highlight are necessarily what is going to resonate with the receiver.
I haven't thought about this until now, that maybe that they were playing me a little bit, because it was RBC and TD. RBC was the lead underwriter, and maybe they had me do the Winnipeg and the Vancouver and Alberta and all that just as practice, so that and by the way, it is interesting how we did the Canadian the first week and then US in the second week. So I thought that's interesting on the roadshow. So maybe there was something. I never considered that they were just trying to, and I was a young kid back then. I was 32 years old, 33 years old or something like that. So I was pretty young when I did this. So, but that I never thought of that. So let's keep going further here. Now, so you've got a business, you've connected with a VC, maybe a couple VCs. Is there any negotiation? Like, how do you negotiate with a VC? Because pretty much it's a standard contract, as far as I can tell. It's standard contract. You get liquidation preference in every contract. Nowadays, maybe with the current environment, it's not looking so good. There might even be a kicker beyond that. But how do you negotiate with a VC, or is there you just take what they give you?
You keep hopping ahead, Colin. It's like you go to you're like, how do you get the meeting with VC? How do
I
you
know we
convince the
only got
VC? How
like
do
20
you
minutes left, so like
negotiate?
we got to go
I
through. We
know.
got
It's like
2
you're like,
shows, Rick. We got to do this,
how,
break this down, but we got only 20 minutes left. So
okay, how do you negotiate with a VC? Well, the most important thing generically when you get to negotiation is to have leverage. And the way you have leverage is to create a market. And the challenge with the VC world for entrepreneurs is, this is not a public liquid market where it's easy to get, lots of people who maybe, want to buy a handful of shares in your company. How do you line up multiple VCs to be interested in your company at the same time? And so the best way to negotiate is from a standpoint of, well, you have a few different options, and you find the VC that you connect with the most and you think can add the most value and that you want to work with, because you're going to be working with this VC for a long time. And so, once you're sure a VC wants to get involved, you'll be able you have the ability to negotiate. But the most important thing is to get them as bought in as possible and to get their partnership as bought in as possible, because that's how you get to the point where you can negotiate. And there's always some room. I mean, for most VCs, there's always going to be some room for negotiation. And there, I think, the accelerators of the world having good mentors is important, because those are the folks that can guide you in your market, given the current market and you know, the current terms and other things. Like, what are people seeing these days? What are companies like mine going for? You know, VCs want you want a fair deal, they want a fair deal. They want to make sure they're going to make money, you want to make sure you're going to make money. And so the way I tell entrepreneurs to approach VCs is usually like, look, I found you, VC. I really think you'd be great to work with, and we've gotten to know each other. Like, we'll figure something out. Like, let's work on this together, and we'll figure out something that's going to work for both of us, because it's going to be a long road together. So that is the way that I tend to think about going in negotiations with VCs. It's going to be a long-term partnership, and it's going to be something where you really do want it to be win-win.
All right. If you're in the audience and you want to ask Ira Weiss, we're so lucky to have him here today to share with us sort of the inside story, the inside scoops behind the scenes of VC. He's a pretty successful venture capitalist himself, and also has invested in a number of companies he's mentioned that have been quite successful. We have Michael on the stage here. Michael, I know you run a company, a software company. Maybe you could just give us, a quick 30-second what you do and where you're at, and maybe any questions you have about raising money for your startup.
Okay, sure. Thanks for having me on, Colin. Yeah, so pretty much my startup is called Pensilla, and it's an AI browser-based design tool that simplifies designing for everyone. About a year ago or 2 years ago, I saw an article on Canva, and it had about a $50 billion valuation. And I was very interested in developing software. So I decided and noticed that there was absolutely no competition in this area. So I went on a 2-year journey to develop a competitor to Canva and Figma. And essentially, it's been a very complicated software to build, but today is actually our launch day. So we're super excited about that. And
Congratulations.
thank you very much. And yeah, it's such a complicated software to build because it requires thousands, tens of thousands of templates. It's based on an X and Y coordinate axis. And we actually pulled it off. And I do believe our goal is to build one of the best design softwares in the world. And I do believe we're not that far away from that.
Okay, so Michael, I know that there's been a number of angel investors who've put some money into that,
Yeah.
including myself, just for the record. Where are you at right now? Like, what is your thought about scaling, distribution, and raising money? And this is a good time, Ira, like, how does someone like this, your revenue, I think you're still pre-revenue, it sounds like, but you're just breaking out right now.
It took us 2 years to develop the product, so pretty much we're just launching today. We have over 10,000 templates. All the bugs are free, and the product is just absolutely fantastic. So right now, essentially, based off your question, what we're doing is I've actually been in e-commerce for about 10 years. So I have some launch strategies in regards to that. So we are going to be doing some paid advertising. What I'm also planning on doing is building an audience via YouTube, because the design where you want to go where your market is, right? Our market's designers. Designers are on YouTube looking for tutorials, design tips, everything. So we have a whole studio set up. We're going to be outputting videos daily. Essentially, it kills two birds with one stone. It will, one, build an audience, and we actually put just our getting started video on YouTube, and we started getting subscribers right away just from one video. So we're going to use that to build an audience. We are going to use a paid ad strategy, because we tested it and it's extremely cheap for us to acquire a customer. Our software is free, because if you look at the market, Figma and Canva, they are free to start. But we have an email flow that is essentially hitting our customers with tons of emails in order to
Got
get
it.
them to
Michael?
upgrade to Pro.
Yeah, Michael, I know we have a very short time here, so
Yeah, sorry.
sounds like you're making great progress. Good stuff.
Yeah.
I'm just trying to get some sense of where you're at with the funding of the company. And maybe, Ira, you might have some advice. I mean, one of the thoughts I had, this is before you logged in on, Ira, I was talking about Start Engine and our crowd, how, that might be a good early stage investment for Pensilla. But I just want, Ira, any thoughts that you might have to help out this young entrepreneur?
Well, first of all, congratulations, Michael. It's amazing to get to this point. It's not easy to get to the point where you're launching. It sounds like it's been a labor of love, and it's a very, very big, interesting market.
Thank you, Ira.
So, I mean, again, it's more like generic guidance, and this is to my students and to my startups, is all about the more evidence you can have that something's working, whatever that evidence is, the easier it is to raise money. And so I think getting to a launch, showing that you can launch, getting a few customers, having some traction, like, early on, it's hard to get evidence because maybe you're pre-launch. But even at the point of pre-launch, it doesn't mean that you're not having, conversations with partners, or, you know, anything that you can show that there's some interest in what you're doing, right? And even getting some dollars from angels shows there's some interest. Getting dollars from, an angel that is a sophisticated angel in the area, getting someone like Colin involved, like those are all signs that something is interesting about what Michael is doing.
And Ira, I just have a quick question. How do you guys identify winners from losers?
Well, I think we always feel like, if anyone we back, we hope that they're going to end up being, the company will end up being a winner. I think, there's a list of probably 10 things that whenever we make an investment, we would love to have those 10 things, but you usually don't get all 10. Maybe you get six or seven. And so, the things that VCs look at are things like, do we have a quickly growing market? How big is the market? Do you have a founding team that has experience in the space? Are there network effects? Could there be some virality to the product, right? Like, one interesting thing about Canva is, designers started using it, and then they would set, you send your final product to someone as a designer, and it says Canva on it, and so then other people find it out. So it's, not that I need to explain to this group what virality is, but there's a list of 10 things. Those are some of those 10 things. And so that is the way we tend to think about it. And we don't, I think as a portfolio develops later on, I think we do end up having some semblance of like what is working better and what is working worse. But, you never know. It could take quite a while, and then something can, take off kind of later than you even expected. So sorry, can't really describe like winner versus loser, but definitely there's characteristics that make you feel like something is more likely to be successful.
I know, like a few months ago, there was a lot of articles about this idea of venture capitalists who look at arrogant sort of entrepreneurs as a liability and tend to fund the entrepreneurs who are able to listen. Is that, do you remember that? It came out of like maybe a half a year ago, something like that. I can't remember, but do you remember that study?
I saw that. I mean, I think there would be a debate in the venture world about that,
Okay.
about whether, like, and I can give some characteristics we tend to look for, but I do think there are certainly some VCs that like the boldness, that like the confidence, that maybe that does verge on arrogance. I think for Michael's benefit, the characteristics that we like to see are, the most important thing is persistence. And it's the ability, there's going to be a lot of ups and downs if you're starting a company. Like, it is just such a risky endeavor, that the ability of someone to be able to persist through the ups and downs and be able to overcome and just continue to grind is really, really important. We also like seeing when, if you found a company and you're working with people that you have worked with before or know, or someone in your really close network. It just gives us a sense of, okay, well, there's people around you who trust you, people who've worked with you before. It's a little less risky to back a founding team of 2 or 3 people than one person. It's a little less risky to back a founding team where the people have worked together before, because it's very common when people start companies that 1 or 2 of the founders, within a few years, and it's often that 1 or 2 of the co-founders may not be involved in the business anymore. So that the tighter connectivity they have at the earliest stage, the better.
Yeah. Well, you know what bugs me about venture capital? And I mean, I knew I'm going to take this on, okay? Is
I
that,
don't, but I'm sure.
okay, you
But I'm
ready?
sure you're about to tell me.
Yeah. It's this liquidation preference. And then you get 1x, 2x, 3x. And, obviously the market today is like, it is a buyer's market today. It's like, the venture capitalists can pick and choose, who they work with and command the terms. But I've never, like, as an entrepreneur, I've done a lot of raises. Again, we've done venture capital too. Okay. I'm okay with that. Like, it depends if it's strategic, if it's, you got to move quickly. I'm 100% in favor of it. But it's just always bugged me that the venture capitalist doesn't take the same risk as the entrepreneur. And I've worked with too many companies. I've been involved in one now. They raised $60 million of venture capital. I'm on the board now. I brought in a new CEO. I'm trying to clean this thing up. And the original founder, who, was there for 15 years, he's wiped out. He's pretty much gone because this concept of liquidation, they don't take the same risk. And I know that this is part of the model. Okay. I'm not gonna challenge you on. There's nothing I can do to say that this is the way it should be or shouldn't be. But I do think entrepreneurs have a choice, and I do think that they don't always have to go down the venture capital route. But what do you say to that? 2x, 3. They want the venture capitalists that want this kind of guaranteed return on investment before the entrepreneur makes their money. And by the way, let me finish with that example. Sorry, that example, he did pretty much get wiped out. They raised 60 million in venture, and had they did not have liquidation preference, he would have walked away probably with about $10 million. So it just seems to me that you want to invest in a company, shouldn't you have the same risk as the entrepreneur? I know that just bugs me. It's a pet peeve of mine.
I mean, I think I've heard that before, and I think a lot of people can appreciate it, which is why, if you're really going to partner with founders, excuse me, if you're really going to partner with a founder, why wouldn't you put yourself in the shoes with the founder and just have common stock and everyone investing together in common, and the venture capitalists not have a liquidation preference? So I hear you, Colin. I think the flip side that VCs would say is, well, we're taking a lot of risk. I think we're willing to give you a higher valuation to take on slightly less risk. And so we take on slightly less risk if there's a liquidation, if there's a basic liquidation preference in place. And I think, when you're describing a multiple liquidation preference, 2 times, 3 times, those are, you never want companies to have those terms. VCs don't want companies to have those terms either. When we get involved, it's always as clean as it can be. We're getting involved really early, usually the first check in. And so we don't want, we're never going to ask for multiple liquidation preference. We don't want anyone else to ever ask for that, because it won't, we're as close to the entrepreneur from an economic standpoint as anyone could be. So, the better, again, what I tell my students and my founders is, like, the better a company could do on the less capital, like, if you can take in very little capital, but the company do really, really well, you can maintain control. You can maintain control and you can make more money. And so that is part of your goal as a founder. It's like, well, you want to, in some cases, you want to be rich and you want to be king. And king is about maintaining control, and rich is about being financially successful. And can you do both of those? And, how do you get to both of those? Well, try to not take on too much outside capital, because then you maintain control. And, ideally you won't end up in the situation you're describing, Colin, which is painful. It's painful, and it's really certainly unfair to founders who put their life and soul into a company.
Yeah. And it's interesting that 90% of companies on the Inc. 5000, fastest growing companies in America, do not have any venture capital. That's interesting. Like, I find that fascinating. Like, there's this obsession in America with getting venture capital. And like, somehow that's the panacea, that's the success. And yet it's the minority. And don't get me wrong, Silicon Valley is an ecosystem that's created more value and more successful companies than any other system in the world. Okay. So it's phenomenal, right? It is absolutely incredible. But at the same time, there are alternatives out there. And I know we as entrepreneurs, as startup founders, we always thinking about venture capital, venture capital, venture capital. And yet, there's a different world out there. Can you talk to us about 2025? Because, it's been a shitty market for the last 3 years. We do something called the Time to Sell Index, which you can get every month. We print it on our newsletter on the Startup Club Edge. Go to startup.club, sign up to the newsletter. You can get a copy of our monthly newsletter, and we have something called the Time to Sell Index, which is you might find fascinating. Ira, we mapped out the last 25 years of troughs to peaks in the IPO market, and based on that, is it a buyer's market or seller's market? Because the theory and the thesis that we have in the book and that I've lived through like in real life, losing $100 million at the age of 29 years old. So, I sort of have a bit of experience in this area. But the thesis is that when you have a market that's frothy with a lot of IPOs, like you saw that, I think we hit almost 1,000 publicly traded companies going public in 2000, and then we had the tech wreck. I'm not getting a year wrong there, but it's already a couple of years later, right? But the reality is, it was a phenomenal year, and then we had the tech wreck, the crypto crash, everything else. 2023 was horrible, and it was one of the worst years. And 2024 was slightly better. We have a 3.6 out of 100 on the Time to Sell Index in 2024. It's just looking a lot better in 2025. What's your thought about 2025?
I mean, so it has been bad. There are almost no public IPOs. I primarily look at tech IPOs, but the market's been, it's not a closed market, it's open, but there just have been very, very few. And if you asked me at the beginning of 2024 when I thought the market would start improving, I would have told you, midway through 2024, everyone has said interest rates are going to start coming down in March. And, the interest rates will start going down in March and they'll keep going down. And by the end of the year, we're going to be in a really good market again. And so I felt that way for 2024. So I would not have, my prediction would have been wrong. I think I would generically feel that way about 2025 as well, that like maybe halfway through the year, things start loosening up, but they're not loosening up as quickly as we had hoped. Interest rates had been coming down, but now they're not. It seems like they've gone up a little bit instead of going down. The public markets are technically open, but there's still not a lot of IPOs. And I think what I would look for is, in like March, April this year, if you do have a bunch of companies going public that are going public based on their financial results for last year and their audited results, and the market starts opening up, then I think things will improve a lot throughout the rest of the year. For my day business of investing in startups and all of our investments, like we really, really want the market to loosen up this year. And my prediction is that like by second half of the year, it will start loosening up. I don't think it doesn't feel like it's loosening up very quickly, even with the change, the change in the administration that's happening on Monday. So
Yeah, and it does seem to flow from the top down, like the number of IPOs. When that's hot, then venture capitalists start investing, and then their acquisitions are happening. Private equity's buying companies. It's like an ecosystem. But when the IPOs stop, it's like the whole market stops, and there's usually a delayed reaction of about 3 to 6 months before we see it all kick in downstream. But that does seem to be the case. Well, you've been listening to Start, Scale, Exit, Repeat, Serial Entrepreneur Secrets Revealed. Michelle, if you have any closing thoughts before we close out here, or Ira, if you have any thoughts. I know we all have a hard stop at 3 o'clock. We're jumping over
Yeah,
to
I
Andre.
think this is some really good advice. It's in alignment with what we've experienced and what we've seen and more. Thank you, Ira. And I feel like we could even almost do a deeper dive call. We should have Ira back and talk about the different phases and the different ways to do it. Like you said, Ira, there's a place for VC and, like getting that proof of concept. But I think there's, some deep diving here, some more information and wisdom that you could impart with us. And I'd love to hear more and hear some like real life stories of what you've seen people do that are successful. Michael, you too, like what you're experiencing. Michael, I think it would be great to have you coming on a regular basis and actually sharing your journey with the community. Thank you.
No, for sure. I'd be happy to be back.
All right, so that's it. You've been listening to Ira. Any last words? Sorry, we'll let you close it out.
For having me on. I mean, I think it's great that you've got groups that you're educating here, and it's, Colin's he's on the ball. He knows what he's talking about. This is great. It's great to get to hear about all the stuff you're working on, Colin.
Great. And if you have ever been on Entree, it's a new app that's come out a couple years ago, and we're going to do a live show now on Entree. It's a masterclass on starting a business, 10 actions you can take to start your business. And if you're listening to this in podcast, you can actually get this masterclass on Entree. If you go to Entree and sign up to their pro membership, you can get access to this. But thank you very much. You've been listening again to Start, Scale, Exit, Repeat, Serial Entrepreneur Secrets Revealed. And we see you all next Friday, 2 o'clock Eastern. And you won't know about Ira. And maybe Michael will have you on as a guest speaker one day when you hit your unicorn status. But you won't know about Ira or other guest speakers unless you sign up to that mailing list. Go to startup.club, sign up to that mailing list. And by the way, every month we come out with the Time to Sell Index, and we also come out with an extensive newsletter that covers so much. Last month we came out with 70 growth hacks all in one newsletter. And a lot of it came directly from the book, but a lot of it was new stuff that we were able to put together at the team here at Startup Club. Thank you all. We'll see you next week. Bye for now.
Take care.